Now, the National Australia Bank has come out today and indicated it's going to cut the special offer it offers new home loan borrowers. Now, this is all about the fact that the NAB has done the opposite of a number of other banks in Australia. Other banks right now are, with the deal flow falling because property prices in Melbourne and Sydney especially also dropping off, and we'll get to that a little bit later when we speak with Jonathan Chancellor. He'll give us the wrap of weekend property markets, but I can tell you it's pretty diabolical. So if only 2 out of 5 properties coming onto the market are selling in a timely manner right now, that means there's a lot of property on the market and a lot of mortgages are not being written by the banks. So given the fact that bank profits are flat, their margins are being squeezed, and so as a result of that, many of the banks right now are being highly aggressive, a home loan price war, if you like, to try and get more deal flow. In other words, more business through the door. So this is a great opportunity, but there is a few caveats. Number one, you've got to be a pretty good credit risk. In other words, you want to have at least 30% equity in your home to make certain that you have, if you like, the negotiability with the banks that they really want your business. Because if you have 10% deposit, say, for example, they probably won't compete, a bit like the NAB right now. Now, as a result, you can see the bank's profits being squeezed up. Some of those last week reported falls in profits, certainly the National Australia Bank, but also today, Westpac, the second largest bank in Australia that also owns St George, came out and said its profits were just a little over $8 billion over the past 12 months. I did speak with Brian Hartzer, the chief executive of Westpac, just a short time ago. Here's just a little of what he said about the so-called home loan price war and the type of business that they want right now.
What I think we have seen is that over the last several years, and for us it's probably going back 3 years ago, we did tighten up some of the credit criteria, particularly around mortgages, building in some bigger buffers on interest rates when we calculate serviceability and so forth. More recently, the changes have been more about documentation and verifying people's expenses and the like. And some people have found that process more complicated and perhaps dissuade them a little bit from applying. But I really wouldn't want people to think that this is a situation where credit's not available.
So that's Brian Hartzer. So the messages right now are mixed. On one hand, you hear Brian Hartzer tell you, no, we're open. We're actually open for business. But then they're also saying, we want you to have pretty good credit records behind you. Others are saying that because of moves by the banking regulator APRA, especially around investors, the credit is now more difficult to obtain. You certainly can't get, if you want it, interest-only loans. You'll need to go out and get principal and interest loans. Now, the credit squeeze is also contributing to, potentially, the falls in house prices you're seeing in Melbourne and Sydney especially. But, if true, that will spread out to other capital cities as well. One man who knows this game better than most is Martin North from Digital Finance Analytics, who's on the line. Many thanks for your time, as always, Martin.
Hello, Russ.
So the reality is there are mixed messages coming out of the banks, with the National Australia Bank effectively closing itself off to, being the cheapest in the marketplace of the big four banks to new home buyers or new, people wanting it, or new customers, as it were. But then saying it wants to somehow reward ongoing loyal customers. But then you've got other banks out there right now fighting like tooth and nail to try and get the next mortgage that comes through the door.
Yeah, it's a bit of a battlefield out there, and I think the banks are chasing their own tails, trying to work out what to do. Just a few facts. Credit is still growing. It's growing at about 5% per annum. So it's not as though credit has disappeared completely, but of course many investors are now just looking from the sidelines. They're not really wanting to buy, which means that effectively it's those refinancing and those first-time buyers who are effectively now very much in the sights of the banks. And because the total deal flow is much lower than it was, and because the bank's profits are absolutely linked to the growth of their mortgage books, they're trying to find ways to grow that. Now, obviously, price is one lever, and NAB didn't reprice their back book the same way as the others did, so they've got a little bit of less wriggle room to start with. And Westpac, of course, was very, very strong on the investment side, so they've seen that evaporate, and so they're caught. And in fact, all of the banks as they shed other types of business, are more and more trying to focus in on the mortgage business, which, of course, is still not as strong as it was.
But it's a shrinking pot. That's the problem. They're all focusing on a shrink pot. So to get that part of that shrinking pot, they've got to cut their price to get some market share. And to do that, they're giving away margin, which means their profits get squeezed up.
Yeah, and all of them have reported margin compression, partly from funding, but also just from pure competition. So the question is then, do you try and attract low-risk refinance deals from your competitors? And that's what some of them are doing. So if you've got an existing mortgage and you want to refinance it and you've got a reasonably good buffer, you'll probably get a really good deal. If you're a first-time buyer, it's actually getting a bit more difficult because, as you mentioned earlier on, they're now asking for a lot more evidence in terms of saving history and your spending history. So that it's more complicated than it used to be. But it is really a very complicated situation. And, as I look across all of the different types of lenders, from the non-banks and from the smaller lenders and the large lenders, I have never seen so much divergence in terms of the different offers and propositions that are out there. But what I would say to people is you'll be very, very careful, because there are still some catches, like you might find a good rate which then goes up to a less good rate. You might find that the fees that are being charged are higher than previously. So those people who are in the market should do their homework. Remember that the bottom line is this: your business is now more valuable to the bank than it ever was because there is less of it about. So, use that as a leverage point if you're actually going to be talking to the banks.
Gee, I'll tell you, it's a really interesting point right now, because the other issue is if the property prices are falling, then the banks also are concerned about their own credit quality. Plus, the Royal Commission sitting on top of this means that there is more onus on the banks to make certain that their customers can afford home loans or any lending that they take on. And so you've got this issue where they want more deals to try to effectively improve their profits, but at the same time, they've got to be careful who they lend to. So this is the real problem. If you have the equity, as you say, Martin, you're in the sweet spot, but that doesn't help battlers who are trying to get into the marketplace.
No, it doesn't. And, it used to be if you had a pulse, you'd get a mortgage. Now it's much more difficult for many people. And I do think there are some people who should be able to get a mortgage, but who can't get a mortgage unless they go to the more expensive non-bank sector, and I'm concerned about that and the risks involved. And I also think that we've got to be conscious of the fact that home prices are likely to continue to slide. Home price movement down is to do with lack of credit availability. Well, like I said, it's still growing. It's not growing as fast as it was. That's sufficient to drive home prices lower. That means that loan-to-value ratios are getting compressed. So some people who have mortgages now are seeing their own equity being eaten up, even as we speak, right? Which means that effectively now the banks will have higher risks in their portfolios too. This is a really, really tricky time for individuals and for lenders, I think. And, I've said it over the last few days, it's probably the first time in a generation that the bankers actually have to earn their corn.
I tell you, it's interesting to watch it. Martin North from Digital Finance Analytics. One thing worth remembering, as we keep on saying, is that while your debts are rising and house prices are rising, that seems like a perfect scenario. But when the house prices start to fall, as they have in Melbourne and Sydney, and undoubtedly might in other capital cities, your debt remains the same until you pay it off. And that is one of the difficulties that people might have some trouble adjusting to. Martin North, as always, appreciate your time here on Money News.
Good to talk to you.
Yeah, Martin North there.